And today we are digging into a really fascinating financial analysis report.
We are. It's all about the Schwab U.S. Dividend Equity ETF, better known as SCHD.
And this analysis is, I have to say, extremely optimistic. It calls SCHD a financial fortress.
And it doesn't stop there. It also calls it an all-weather compounding machine.
Which is a pretty bold claim.
It's a very bold claim. So our mission today is to figure out how one single investment can possibly live up to that. The idea that it can win whether the market is, soaring, crashing, or just going nowhere.
And this really speaks to anyone out there looking for safety without sacrificing growth. People looking for passive income, retirees, or maybe you're just a fearful investor.
Right.
The question this analysis tries to answer is, how does this one ETF manage to perform in every market? And it's looking specifically at the outlook for 2026.
And just for context, we should mention something that happened recently that makes it more accessible.
Oh, yeah.
The analysis we're looking at mentions a share price of around $27. That's because of a 3-for-1 stock split back in October 2024.
So it just made it a lot easier for new investors to buy a whole share. But the core strategy, the methodology, that's what we're here to talk about.
Mm-hmm.
And that hasn't changed at all.
Exactly. So is that methodology actually sound?
The analysis argues it's more than sound. It's aggressively defensive when it has to be. And to really get why they call it a fortress, we have to start with how it behaves when things go bad.
Okay, so let's unpack its defense mechanism. When the market is in a full-blown panic.
Which can be triggered by, high interest rates or a big tech sell-off.
Right. That's when speculative stocks just get crushed.
They do. And the report's thesis is that in those moments, all that money has to flow somewhere. It flows to quality.
And SCHD is basically built to catch that flow.
That's the core of its stability. Its index is designed to only hold companies with really stable, less volatile earnings, no matter what the economy is doing. It all comes down to its heavy allocation in defensive sectors.
Okay, so which sectors are we talking about here? What's keeping the lights on when everything else is going dark?
It's mainly two areas: consumer defensive and healthcare.
The essentials.
The absolute essentials. Think about it. During a recession, people stop buying new cars or fancy gadgets, but they don't stop buying toothpaste or Coca-Cola or their prescription meds.
So you're talking about the giants. The analysis points to holdings like Coca-Cola and Pepsi, or pharmaceutical companies like Merck and Bristol Myers.
Exactly. These companies generate tons of cash flow because demand for their products is, it's inelastic. It doesn't really change with the economy.
That allocation really is a huge anchor in a storm.
It is.
The analysis has a great term for them. It calls them boring but beautiful.
I love that.
It's perfect, right? We're talking about Home Depot, Chevron, Lockheed Martin. These are businesses that just make money, rain, or shine.
They're not going to give you those crazy 10x returns, but they have real financial integrity. And that brings us to the second defensive layer, which is maybe even more important.
The dividend itself.
The dividend. The analysis says SCHD has a dividend yield of around 3.8%. Now, picture a really bad crash, like the S&P 500 dropping 20%.
A scenario nobody wants to think about, but it happens.
It does. For an SCHD investor, that 3.8% dividend is an immediate cushion. It's cash that just keeps showing up in your account no matter what the share price is doing.
So right away, the drop doesn't hurt as much. You're already almost 4% ahead of someone in a pure growth fund.
Precisely. But here's where the real magic is, according to the report. What do you do with that cash?
You reinvest it.
You reinvest it. You're getting capital to buy more shares at those new, lower prices. The report calls it the ultimate buy the dip cheat code.
Huh, I like that. You don't have to find new money. The ETF is generating it for you.
Exactly. You're compounding your growth when it's cheapest to do so.
Okay, that's a powerful defense. But I have to push back a little here. The common thinking is that if you build a portfolio this safe, you're giving up growth. That's the trade-off. It sounds like something for a retiree.
And that is the biggest misconception this analysis tries to tear down. It argues pretty definitively that no, this is not just a retiree's ETF.
So it's not just about the static dividend yield.
No. It's about dividend growth. That's the secret to how it performs in a bull market. It is engineered to capture rallies.
Okay, so where does that growth engine come from? How does it accelerate when the market takes off?
Well, it comes from the other parts of the portfolio. It's not all boring consumer staples. It has significant holdings in sectors like financials and industrials.
The more cyclical stuff.
Right, the sectors that really boom when the economy is strong and people are confident.
But wait, doesn't that introduce the very risk we are trying to avoid? Financials and industrials can get hit hard in a recession. That seems to contradict the whole all-weather idea.
It would if it just bought the whole sector. But that's the key. That is where the screening methodology is so important.
It's selective.
Very selective. It isn't buying every bank or every industrial company. It's only buying the absolute highest quality heavyweights. The analysis says it's designed to hold companies that give you a pay raise every single year.
A pay raise. I like framing it that way. It's much more tangible than just watching a stock price go up and down.
It is. The growth comes from a really strict requirement. The companies it holds must have 13+ years of consecutive dividend increases.
13 years. So that proves the business model can survive and even thrive through tough economic cycles and still have cash left over to give back to shareholders.
Exactly. It's a signal of incredible durability. That rising dividend is your guaranteed growth component.
Okay, so we've covered it's a mix of defensive anchors and growth-oriented leaders. Now let's get to the how. What is this secret sauce? What is the filter that makes sure only the best companies get in?
The secret sauce is the index it tracks. It's the Dow Jones U.S. Dividend 100 Index. And you can think of it as this incredibly rigorous quality filter.
A filter designed to avoid the common mistakes people make.
Yes, especially people chasing high yields. The number one thing it screens out is the yield trap.
Let's define that because it's a critical concept.
A yield trap is when a stock has a really high dividend yield, maybe 8, 9, 10%. It looks amazing on the surface.
But it's a mirage.
It's a total mirage. The yield is only high because the stock price has collapsed, usually because the company is in serious financial trouble, and that dividend is probably about to be cut.
So you're chasing fool's gold and you end up losing a lot of money.
Exactly. SCHD's methodology just sidesteps that completely.
Yeah.
It looks past the yield and straight at the company's financial health, using two really important metrics.
And what are those?
High cash flow to debt ratios and a strong return on equity.
Okay, let's break those down. Cash flow to debt. In simple terms, what does that tell you?
Think of it like a personal stress test for a company. It basically asks, how quickly could you pay off all your debt using just the cash your business generates?
So a high ratio means the company isn't drowning in debt.
Right. It means they have plenty of cash to handle a crisis, pay their bills, and most importantly, keep raising that dividend. It's a huge safety check.
That makes sense. Okay, what of the other one? Return on equity or ROE?
ROE is all about efficiency. It tells you how much profit a company makes for every single dollar of shareholder money it invests back into the business.
So it's a measure of how good the management is at their job.
It's a perfect measure of that. A high ROE means you have a super profitable business run by a smart, efficient team. They aren't just sitting on cash, they're creating more value with it.
So to get into SCHD, a company needs a long history of raising dividends, the ability to pay its debts easily, and be run by an efficient management team. That is a tough screen to pass.
It really is. And that rigor is why the analysis says it's still a good value right now. Let's look at the numbers it cites.
Okay, what's the data telling us today?
Well, we mentioned the yield is still a juicy 3.8%. But the valuation is what's really compelling. The price-to-earnings ratio, or PE, for the whole portfolio is sitting around 17.18.
And why is that number significant? How does that compare?
It's significant because it tells you what you're paying for those earnings.
Mm-hmm.
And compared to the S&P 500, which often has a much higher PE, this means SCHD is relatively cheap.
So you're getting quality at a discount.
That's how the analysis puts it. The analogy they use is that you're buying dollar bills for 90 cents right now.
And you get to keep almost all of the returns, right? What about the fees?
A crucial point for any long-term investor. The expense ratio is just 0.06%.
That is tiny.
It's ultra-low fees, as the report says. It means there's almost no drag on your returns over time. Your money's actually working for you, not the fund manager.
So to sum up the structure, what are the top sectors in the portfolio right now?
The top three really tell the whole story. They are financials, healthcare, and consumer defensive.
There it is again, the growth and the defense right there in the top three.
It's a perfect pairing. Financials for when the market's running hot, and healthcare and consumer defensive for when it's not. It's a beautiful balance.
So synthesizing all of this, what does it mean for you, the listener, trying to build a solid portfolio for the long haul? It really seems like SCHD is designed to check all the boxes: safety, growth, and income.
That's the core thesis. The performance isn't an accident, it's engineered. The quality screens let it hold growth sectors without taking on huge risks.
You get the growth from those consistent dividend raises.
And you get the safety from the financially stable companies and that dividend cushion when things go south. It really does seem to earn that all-weather title.
And the lessons here go way beyond just this one ETF. These are universal principles for smart investing.
Absolutely.
Yeah.
Which leads to a final thought for you to think about. If this rigorous screening process, using metrics like return on equity and cash flow to debt, is so good at finding quality companies,
Right.
then what other characteristics beyond just the dividend should you be prioritizing when you look for investments to build your own long-term wealth? The tools used here to find a high-quality business, well, those are universal.